Okay, friends, I hope yesterday we solved only one question, right? Yesterday we did discuss which costs. Check your notebook. We have discussed KD and KP. Is that right, people? We have discussed KD and KP, correct? I'll show you that. Wait. Right, friends, this is what we started yesterday, correct? That we will discuss that we will be talking about specific cost of capital, true? And then we went on to understand this, right? Specific cost of capital. And yesterday we did talk about this KD and what KP, correct? And then we did solve one question based on it. And that was question number 1, correct, people? Okay, so today initially we have to solve few more questions based on this, and then we will learn the next costs. Okay, fine. So let's start with it. We'll come to question number 3. Okay, let's read question number 3, every one of us. So see what is told in question number 3. Okay, follow the sequence that I'm asking you to follow, guys. Okay, there is a reason. See, other things. Are we done with KE? Are we done with KR? No. Lot many other things are still left. So if you'll ask me, sir, why not? Second question. Then obviously certain things are not yet done. So not doing that. Okay. So let's talk about question number 3. 5 years ago, Sona Limited issued 12% irredeemable debentures at 103. So question is very clear. Irredeemable. Follow the question. Simple as that. Okay. But these details are all 5 years ago. See, current market price of these debentures is how much? 94, guys. Okay. Company pays a corporate tax of 35%. What is the current cost? See, when we are asked for the current cost, this data of 5 years ago becomes a sort of irrelevant. Okay. 5 years ago, Sona Limited issued 12% debentures 103. That is at 3% premium. All this becomes irrelevant now, right? This all data is what? 5 years ago data. Therefore, what? Not needed for current calculation. Correct, friends? Now you know what you have to do. You have to calculate it for what means what it is. Redeemable data given or irredeemable? Irredeemable or redeemable? It is irredeemable. Okay, tell me like that. Small formula or the big formula? The smaller formula, right? Okay. So let's put that and get the answers. what we have to calculate is KD, right? So let's collect the data one by one. Let me open the question. Just interest would be 12% of 100 face value. This is 12. Then how much is the tax rate given? 35%. Okay. How much should I take net proceeds? Guys, we have to calculate current value, correct now? Remember that. So this has to be current value, not what it was 5 years ago or 3 years ago, what you are told in the question. Do you understand what I'm saying? So how much you are going to take? Are we going to take the current value, net proceeds given as how much? Or the market price given? 94. If I have to find today's value, I have to take today's proceeds. 94 rupees. Everybody agrees on this? Okay, thank you. Yes, people. So you're good to go. Therefore, KD is equal to interest 1 minus T upon what? Net proceeds. Tax rate is 35%. So 1 minus 0.35. And the net proceeds are how much? 94. You can write your answer in the chat box. Absolutely. Guys, round it off to the 2 digits. I've always told this. I don't know whether people are following or not. So it comes only to 1 digit, sir. Now see, if it comes to 1 digit, we have nothing to say. Okay, but otherwise, I hope from ratios topic, I'm telling you general instruction, right? After decimals, at least 2 digits. The moment I said at least 2 digits, then Sanya, Shweta, they're like, okay, sir, 2 digits you want now, so 8.30, correct. Jinesh, not 8.23, dear. I said give answer in 2 digits. That's why you should not give a wrong answer. Now see guys, understand that. Come on, if it is 8.3, that is fine. Okay, that is fine. 8.30 and 8.3 means same, we all know. Okay. Priti, answer is not correct. I hope people understand how to round off. Okay, sir, please keep one lecture on rounding off. See guys, This is what you get as an answer. Right? 0.082. Right? Every one of us agrees this is what our answer is. Correct. So if you're not very confident how much this comes for, into 100 you do, then it becomes 8.297. How to round off? If the third digit is 5 or more than 5, then what to do? Add 1 in the previous digit. So if in 297, because the third digit is 7, if you add 1 digit, it will become how much? 8.30. What? People understand or not? Huh? Am I talking to CA Inter students? So much. People, you don't get my sarcastic voice. You feel na? You're getting that feel na? Huh? What people are answering in the chat box, just that the chat box is there to type. How can you calculate wrong numbers after writing this? I write this, then the rest of the thing is to be done by calculator now. Skills are skill. Understand? Come to next question, please. Come to question number 4. Now it's going to be more interesting because people's skills are so much immense. That is going to reflect when we come to calculations. Let's read question number 4. XYZ Limited issues 2000 10% preference shares of 100 each. Of 100, guys, of 100, that means 100 is a face value, correct? At rupees 95. So 95 is what? Is the issue price, what we call it as what? Net proceeds. The company proposes to redeem the preference shares at the end of what? 10th year from the date of issue. Guys, company proposes to do what? Company proposes to redeem at the end of 10th year. Guys, you are given details of redemption. N is equal to 10. Redeemable type. Okay. That means what? Small formula or big formula? Big formula, very big formula. Correct? But in that very big formula, you need redemption value also. Okay, you read the question just now. Okay. After reading the whole question, tell me anywhere is it told anything about the redemption value? Then what to do? Face value. Face, hello, what do so man? Face value. If no details are given, then always assume what? Redemption at face value, face value. Okay. Yeah. So come on, let's solve this. Redeem at par. Correct. Okay, so let's come to this. Solution to classwork question 4. Let's gather all the data, guys. Let's gather all the data. Okay, what is told? Preference dividend. So it's 10% preference shares, right? So preference dividend is going to be 10% of 100 face value. So 10. Okay. Then redemption value. In bracket you write RV. That's how we write in the denote in the formula, right? Redemption value RV is equal to 100. We'll say at par since details are not given. Correct, friends? At par since what details are not given. Then net proceeds, right? NP. What are the net proceeds? The preferentials of 100 each are issued at what price? 95. So, guys, that we have to take as question only, na? Wait, Sania. N number of years. How many years? 10 years. Okay. So you have all necessary data to calculate the KP. Therefore, KP is reference dividend plus RV minus NP upon 10, everything divided by RV plus NP upon 2. Hope you calculate correct. That is the only basic thing. Now I have given you the formula. Just fill up the numbers and calculate correct, guys, please. Round off to 2 digits, Ray. Round off to 2 digits. Okay. So we start getting variety of answers. 10.77, 10.8, 9.74, 10.77. Hey, everybody getting, majority getting 10.77. Who is this 10.8? Oh, 10.77. Majority. Who is this 9.74? Mukilan. Where are you? Mukilan, I saw him sometime back. Ah, he's there. Mukilan. You're hungry or what early morning? Huh? Pay attention to what you're doing. People, Roshni, you're writing 10.76. What is your problem, people? Somebody or else has to make a mistake in rounding off. In all, by all possible usage of my parliamentary language skills, I'm telling peacefully, quietly, that please round off at the second digit. One calculation I'm asking people. People are showing me so much variety in that also. Huh? One after giving all the values. This is 10. RV is how much? Redemption value 100. So you have to write 100 minus 95 upon 10 divided by 100 plus 95 upon 2. Guys, this is what the only thing I wanted you to do, right? 10 plus, this is 5. 5 by 10 would be how much? 0.5. Okay. Upon 100, this should be 97.5. Still, I don't have else. Plus 95 divided by 2. 97.5. Ah, guys, this much you can't give me one standard answer. 10.5 divided by 97.5. People, so many times, so many times. See, you can't get this. You can't get this. 10769 na. 1077 na. 10.77%. Oh, thank God. People, please follow certain common rules. Okay. See, I always ask my students, are we animals? Answer is yes, but we are socialized animals. Correct. Follow certain rules. No? Whatever all animals do outside on the road, do we do like that? No, we follow certain rules. Through that, I'm also asking you to do the same thing, friends. Round off after 2 digits. And if possible, calculate correct answers. Early morning, don't give me shock treatment. So let's come to the next part. Okay, guys, see now. Now everybody attentive, huh? You know, everybody like alert. Yes, sir. Okay. Pay attention. We are going to talk about the next part. That is what? Cost of equity. It's really very, very important discussion. Fine. So pay attention. You remember we are talking about specific cost of capital. You remember that we are done with cost of debt. You remember that we are done with cost of preference. Good. So now we will talk about what? Cost of equity. Okay, fine. So let's go ahead with cost of equity. So fine, people, let's start with it. Very important thing. Give the heading. Cost of equity. In bracket you write AE. Okay. So you know now that I have to dictate something to you people, but then I stopped dictating because I lost my network. Please repeat. Last line, second last line, first line. First line's last 2 words, last line's first 2 words, middle 2 words. Can you please talk again? So I started, I dictate, but then I basically write. So even if you miss a word or two, it is there on the screen. Don't make what is that? Don't do that. I'm writing. Okay, let's start. The major difference between KD, KP, and KE. Okay. See, KD and KP. You understand KD, KP now, or you want me to write full cost of debt, cost of preference? You understand, right? Now we need to know this that KD is cost of debt. You can see, okay, you might have you don't understand. You write it full now. What would you do in the exam? Exam, they tell you estimate KD. We don't understand. Will not solve. You can't do that. Cost of debt is KD. Cost of preference is what? KP. Okay, fine. So KD and KP are fixed contractual and always positive. Correct, friends? We know, no? Fixed amount is fixed, contractual, decided in advance, and always positive. You can't go to bank and bargain. Okay, what's your rate of interest? The bank says, okay, ours is 8%. No, no, no. We want minus 2%. Means you take a loan from bank, bank will give you 2%. Very good. Is that possible? No. So it is fixed, it is contractual, and always what? Positive. Always positive. Returns on equity are uncertain. Okay, right? I'm giving the words. There we write fixed, here we write uncertain. There we write contractual, here we will write residual. Residual, you understand? Residue, you understand? Leftover. Residue is what? Leftover. You know now. When we start making an income statement, where does Poish appears? In the first line or always in the last line? Always in the last line. Now that tells you about his position of receiving profits. Okay. So it is uncertain, residual, and can be negative, nil, or positive. Right, friends? Equity shareholders cannot ask for dividend as a matter of right. What's it, guys? You agree with the statement that I have written? They cannot ask for a dividend as a matter of right. See, debenture holder can always say, my returns are fixed, you have to pay, means you have to pay. Can equity shareholder take that stand? No, he cannot. Then also, equity shareholder has certain expectations about equity dividend, which are, I'm sorry, which are based on factors like risk in business, growth prospects, returns given by competitors. That also makes a difference. That my same business competitor is giving 12% dividend. Why don't you give me dividend? Every equity shareholder will obviously having this, right? So the equity shareholders cannot ask for dividend as what? As a matter of right. Then also, equity shareholder has certain expectations about equity dividend, which are what? Based on factors like risk in business. What is the normal thing, guys? Higher risk, higher returns, okay. Growth prospects, returns given by competitors, etc. If expectations are not fulfill the equity shareholders may do what? May sell the shares, causing MPS, and in bracket I'm writing wealth to reduce. Right? Do you agree with this? See, if I'm not happy with the returns provided by the company, what would I do? I'll sell the shares. Tomorrow, if every shareholder starts selling the share, what will happen? There'll be selling pressure. Basic economics, guys. High supply, low demand. Prices will start coming down. Is it in favor of company? You know that every finance manager has the ultimate aim of what? Maximization of wealth of the equity share. Remember that MPS has to increase. Right? So because of that, what happens? See, because of that, what happens? Therefore, expectations of equity shareholders becomes cost of equity. Right? See, earlier also I had taken this stand and explained you that please remove that thing from your mind. But equity shareholders are like, okay, domestic production, right? They are ready with everything, they are okay with everything. Right? That you don't give them dividend, everything is okay. Correct, people? Not that. They also have certain expectations about what? Certain expectations about dividend. They have certain expectations about dividend. If those are not fulfilled, then what will happen? Obviously, what will happen? They would sell their shares. They would sell their shares. You get me? So what we say, expectations of equity shareholder only becomes what? Cost of equity. But you guys know, it is very difficult to know the expectations of people. Huh? We are turning to a very complicated question. What people expect. Okay? We are turning to a very complicated question that what people expect. Because we know whatever life you have gone through, more than double I have gone through of yours. It's very difficult to know the expectation of people and it's very difficult to fulfill them. Right? Means now we are entering into, please understand this, because for KD and KP I give you one formula and I ask you to follow that. But now we are entering into a certain space or uncertain space. Uncertain space. Right? That's why various people will do what? Various people will have various options, opinions about estimating what? Estimating KE. Do you understand what I said yesterday also? While winding up the lecture, I told you that see, we all have studied Newton's law of gravitation. Only he gives law of gravitation. Others follow that. Right? But when it comes to demand supply analysis, many people give their own versions. Why? Because the basic thing is that it is based on a uncertain thing that is a human material behavior. Are you getting me? What I'm saying? Okay, that we are now entering into a kind of an uncertain space. We cannot have one formula. Guys, we are going to have numerous formula for estimation of what? K E. Right? See, sometimes out of K, some other K. You know what? Nowadays, like people are aware about pollution and air quality index and everything, right? So there are various organizations who calculate AQI, air quality index. Right? So you Google out no of your place, air quality index. Then you have a choice. Some people show very poor, some people show moderately poor, some people say moderate, and some people say very good. So I always open that site where it tells me that air quality index of my area is very good. Everybody has their own way of interpretation. So I hope you understood that I'm not going to give you one formula, right? And see, always remember whatever I'm writing, it's me to write, but these are the various theories proposed by various people, correct? So don't come and ask me at the end, sir, what is your opinion? What we should follow? You should follow what has been asked to follow. Correct? So means I'm just trying to make your mindset clear that now we cannot have one single formula for everything. Am I clear to this discussion? Okay, so let's start. And I hope I was dictating, so you must have done writing also in meanwhile, right? Okay, so let's go ahead. So let's start with it, guys. So the very first thing that we'll note today is no growth approach. What this no growth approach has to say. Every year, same amount of equity dividend is paid. Okay. No growth approach. Every year, what? Same amount of equity dividend is paid. Equity shareholders do not expect any growth in dividend. Okay. They are happy with the current rate of dividend. That is also important. They are happy with the current rate of dividend. If they're unhappy, then what will happen? They will sell off the shares and leave. Right? So these are the basic assumptions of this theory. Okay. Now, no growth approach, guys. You tell me. You join a job. Okay. You complete your chartered accountancy course. And another 4.5 years, and you join a job. You're offered a salary of, say, by going by that standard at that time, after 5 years, you're offered a salary of, say, what, 1 lakh 50, 2 lakhs per month starting. Fine, na? You have a problem, you tell the employer. He will immediately reduce it. No problem. If you like, then you can always tell him, sir, this is too much, sir. I don't want this one. You say, okay, you don't take only. Just come and go. Very happy. At least they are wanting some constant. You are the like, you don't want only. You start getting 1 lakh 50 per month at the age of what, 23. There onwards, from age of 23, if you think about, you will have another 37 years of working life. Assuming that you stop working at 60. See, if you as a chartered accountant, you practice, you can practice till the last breath. Okay, you are on a deathbed, you can put a last signature for the last time. Nobody stops. Okay. But fine, 37 years you work, post at the age of 23 you are set for the job, and another 37 years you work. Every month same, 1 lakh 50. 24th birthday you celebrate, 1 lakh 50 per month. 25th birthday you celebrate, 1 lakh 50 per month. 60th birthday you are celebrating with your family members, wives, husbands, kids. 70th birthday with kids, grandkids, 1 lakh 50 per month. Is that done? No. You expect some growth. So what happens? So this is not acceptable to us. Okay, fine. It will not be acceptable to you. But then tell me, different people have different thought process. Not everyone works for money. That you have learned also. And most of the businesses work with profit as a motive. But there are some businesses who work on service or charity as a motive. Correct? So see, theoretically this is possible. Theoretically this is possible. Okay, you might find an organization behaving like this. Okay, so you have any example of this? I also strongly believe, like you only, that nobody would be happy with this kind of organizations. Obviously, no, nobody would be happy. Okay, unless I stumbled upon a, a cooperative bank in my when I grew up, I came to know that my parents had purchased the shares of a cooperative bank. They means when they came to stay over here where I'm staying, it was supposed to be a jungle sort of. People still strongly believe that I stay in the forest, but it's not so. Okay, I'm in the middle of the city. Yeah, I have very good greenery around and good environment. That is different. But when they came over here, maybe in 1970, so almost 50 years back, so it was a jungle. No banking facilities were available. So some group of people joined hands, formed a cooperative society, and started a cooperative bank. My parents were one of them. Okay. They were the initial founding members. Then what? Okay, some basic investment was done by them. Every year. The bank gives a standard rate of dividend, 15%. Because you all understand it's a cooperative bank, so shares are not transferable. Every year, standard 15%. And whenever they all are of a different mindset. Whenever there is some issue, like in 2001, there was an earthquake, right? In Bhuj, Kutch, Gujarat, a major earthquake was there, right? Prior to that, 99 Kargil war, all such national emergency events, all shareholders, by single vote, we don't want dividend, transfer it to government. Now what? Different mindset. They have never complained to the bank. No, what is this? So every year 15%, make it 16, make it 17. No, nothing doing. So exceptional situations can always be there. So this is an approach where equity shareholders are very happy, relaxed. Okay, not everybody has making money as a sole aim of life. It depends from person to person. Okay, so I tried to give you an example for this approach. Okay, it might be 1 in a lakh. That doesn't means that it is not impossible. The possibility is less. but it is not impossible. Okay, fine. Then, sir, what about the formula? Hello, you forgot that. What we pay upon what we got. That doesn't change. That doesn't change. So in this case, how would be the KE be? Therefore, KE would be D1 on P0. Okay, now let me introduce these terms to you. Okay, P. Okay, first let me write D1. What is that? Dividend expected at the end of the year. Right now, people, see, if I buy the share today, when will I get the dividend? Today? At the end of the year, I'll have to wait 1 year, no, at least. Right now. Okay, but when I have to buy, I have to buy it today. So I will buy it today, looking at the dividend that will come after 1 year. Correct? Will you do that? Or you don't agree? Or see, you are studying hard, so hard, looking at the salary that will come after 5 years. Today is institute paying you any single paisa? No, sir. We have to rather pay our registration fees. So you are looking at the returns that will come to you after 5 years and keep coming till you retire. Looking at that, you are investing today, na? Same thing, right? So what will be this P0? P0 is a current market price. Okay. See, what am I going to write after this? Same as net proceeds. Guys, I'm not repeating net proceeds every now and then. I hope you understand net proceeds. We have discussed net proceeds earlier. Tell me what is that? Face value plus security premium minus discount minus flotation cost. Yes, it can be brokerage commission as given in the question. So we remember like that. Face value plus security premium minus discount minus flotation cost. Is this clear to all of you? Okay, fine. I hope you must have done writing. So, no growth approach. Which is what we would like. So, let's come to second one. The second approach is constant growth approach. Okay. Second approach is what? Constant growth approach. Now comes the matter of discussion. Comes the matter of discussion. We are going to have a good positive discussion. Okay. Right. Because getting through this formula both means logically, mathematically. I'm supposed to teach all CA Foundation pass students, right? So I expect that you have a good knowledge of math steps, right? So I expect you understand what is arithmetic progression, what is geometric progression. You understand perpetuity formula in geometric progression. Maybe. See, means I'm going to put a formula in front of you now, right? If I will show you 2-3 ways of convincing you. You know, guys, if you know everything, then you're like happy. Huh? Otherwise, you like buy it, mother. As far as possible, we don't want to do that. So let's get into it. Okay. So here, constant growth approach. You know what happens here? Uh, K KE is going to be D1 upon P0 plus G. So we know already what is D1, we know already what is P0. So not to talk about that. What is this G? G is the growth rate. Growth rate expected in dividend. Now, because we have a growth rate, D1 would be D0 plus G, right? What is D1? Dividend expected at the end of the year. So what is D0? So it will be dividend just paid, correct? To that you have to add a growth. To that what you have to do? You have to add a growth. Okay, fine. Now how to approach to this growth rate? So now see, now we are talking about adding some growth. Earlier formula was like D1 upon P0, matrix, no growth, right? Now what we are saying, no, now we want a growth to come into it. Okay. So how to go with this growth rate? See, I'll explain. Various, again, there also, there are various ways to estimate the growth rate. First, it can be taken as average value of growth rates of dividends in past years. Okay, so what do? You go through what is the growth rate in dividend in past years, like 4%, 5%, 6%. Okay, and then take the average value of it. Estimation, right, guys? We are just understand whatever you estimate has to be fairly accurate. In case of equity, can you calculate accurately? Hello, is it possible to calculate accurately? No. Why? Because it is all about what? Expectations. Trying to give numbers to the expectations. Fine. So we cannot be accurate. That's why how we'll estimate? We'll estimate like this. Okay, fine. This is one of the options. We'll estimate like this. What we will do? We will go historically. Realized yield approach. We'll go historically. Fine. Last year, what was the growth rate? 5%. Last year, before that, 5%. Before that, 5%. Okay. All 3 years, 5%. So what will be the average value? 5%. Okay. So whatever is the D1 upon P0, to that we'll add 5%. Did you understand what I said? It's a tentative way of getting the things, right? You know what? Sometimes I'm asked a very absurd question by student. Okay, doubt solving. So you can ask anything. One of the thing is that, sir, what salary I will get when I become a student? Now, say, how do I answer this question? It's very difficult for me to answer this question. Very difficult, because I think it depends upon your qualification, your understanding of the subject, personal, your own personal aura. Na? When you step in on interview, your evaluation that a company does. So it's very difficult for me to tell like that. But then yes, industry standard going on like that, you can give some number. Whatever number you give, that is not a contractual promise. So if as I told you right now, that you become chartered accountant, so going by today's standard, should make monthly 1,50,000, 1,75,000 after 5 years also, easily. Right, if you have a good academic record. Okay, Suppose you don't get that offer, you get 1,25,000 as an offer. Directly from home, you send a court notice to that you did not estimate correctly. See, that is not possible. It's about estimations. Right? So, fine. This is one way by which what we can do. We can estimate the growth. Okay. Can there be other ways? Yes, there are other ways. Listen to me. One is going with the average values. Okay. Second option is there. Okay. Uh, G can be written as what? B into R. Each word has its own meaning. Okay. Guys, when we talk about dividend decisions, there's one topic known as dividend decisions. Yes, now you can see in your book. Not there. Remove. So much you're checking now. Is there now? Take your time. You should see the index. You'll immediately get it. Tenth chapter. Thank you for the valuable information. Okay. So when you'll go through this now, that time you're going to meet one person. Okay. His name is Gordon. No, not Garden. Gordon. Gordon. Okay. So he gives this idea. This idea is put forth by Mr. Gordon. Okay, he gives this idea. What is G? G is B into R. So B bar bar, R bar that. No, wait. Here, B is retention ratio. So that's not fair, sir. B, the name is not retention, the name is retention. So give R to that. But if I give R to that, then what do I give to the other R? The other R is ROE. Okay. ROE, returns on equity. Okay. Sir means what? Yeah, that means what is always there. Na? Means what, sir? You wrote something, we wrote something. But what, sir? What you are trying to tell and what Mr. Uncle, Gordon Uncle is trying to tell? Okay, let me tell you. We'll put some numbers to this. Okay, guys, first of all, you all tell me. You know that retention ratio is 1 minus dividend payout. Which topic we have learned like this? Ratios, correct. Accounting ratios, right? So if I give 40% dividend, 40%, then retention is how much? 60%. Everybody understands this? Sure. Okay. You lead a very meaningful life now when you give correct answers. No, if you say, okay, now I'm done. Even if God says, okay, come, okay, I'm ready to come. The day you give correct answer, God says, chill, time up. Okay, no problem. Okay, how to calculate? So let's take some simple example. Okay. Suppose, guys, board of theory. At least let me complete this. Then we will shift our focus to questions. See, we just now started. Don't tell me that since 2-3 days we are doing theory only. We have added only one formula till now. That is cost of equity, that to zero growth or no growth. So this is only the second formula, constant growth. Am I loud and clear? So pay attention. Let me give you a very simple version of this. Suppose in year 1, you introduced a capital of 100 in your business, okay, on which you earned a profit of 20. You declared dividend of 10. Okay, so retention is how much? Retention is 10. And if I ask you B, that is retention ratio. This one, guys, this one. Can I say it would be 50%? That is 0.5. Yes, people. You understand what I have written? Sure. Okay. Fine. Now let's go one step ahead. Now, in year 2, what will happen? In year 2, 100 is the capital, no doubt about it. But you know what investors are going to say? Investors are going to say, see, we invested 100, no doubt. But the profits also belong to us now. You're not giving our 10 rupees. You're reinvesting that 10 rupees in the business. What's it, guys? Correct. You're reinvesting. So it's as good as you have 110 investment now, reserves, capital plus reserves. Correct. Okay. So now, what is this rate you understand? 20%. Profit is 20%. So how much it would be this year? 22. Correct? Right. So what will happen? You will tell me. If the profit is 22, how much should be dividend? 11. Right? You will understand this? Okay. Retention would be another 11. Okay. Now, guys, you tell me how much is the growth in the dividend? How much percent is the growth? 10%. Everybody agrees on this? Sure. How we got it? So we got it as G. G is equal to B into R. Therefore, growth G is equal to B into R. B is what? Retention ratio. Confirm 0.5. R is what? Returns on equity. Guys, you did not observe that or what? Capital 100, profit of 20 means ROC is how much? ROE is how much? Returns on equity is 20%. Isn't it? 20% is how much? 0.2. Do it in your calculator. Do it in your calculator. 0.5 into 0.2. 0.1. 10%. Did you understand this? In absolute terms, you have understood this. Right? Okay. I have another version for this. Another version of explaining the growth rate. Okay, I'm not yet done. I'm showing you all the possibilities so that you come across anything, you will have something standard to refer in the theory. Okay. So we're talking about various ways to estimate growth. Okay, this is first thing, this is second thing. Now the third thing is the derivation of this one. Yeah? The third thing, G is equal to what? B into R. This is a derivation of this thing. I repeat it. What is B? Retention ratio. What is R? Returns on equity. Okay. Let's elaborate a little more. Retention is 1 minus dividend payout. What's it, guys? Correct? 1 minus dividend payout. Okay. Returns on equity is Payesh upon what? Equity share holders funds. In 200, I'm not right. Okay. So that we have the flexibility of solving. But we know that in 200 it can be anytime be there. Whatever answer you get, suppose you get 0.8, so 80%, 0.7, 70%. Right? Fine. Guys, I'm sure that you must be having your accounting ratio notebook over here. I'll just repeat that. See, dividend payout. Dividend is paid out of which profits? Earning per share. So I can write this as, let me take it on the Excel now. I can write this as what? 1 minus dividend paid out is out of EPS. So DPS upon EPS. Okay. You must be remembering this, that we have written this already as EPS minus EPS upon EPS, and I have told you that don't cancel that EPS. Check in your book, in your accounting ratio. We have written 2-3 versions of all this on the single share, on the full capital, like that we have written. Okay, one of the expressions is this, that EPS minus DPS. So this becomes our retention ratio. EPS minus DPS. EPS is what we earn, DPS is what we pay. Whatever is left out is EPS minus DPS compared to EPS. Okay. So what to do with this? Payesh upon equity shareholder fund, please send. You know that any number, you multiply and divide by the same number. Any number, you multiply and divide by the same number. The value remains same. Sir, you forget your subject only, sir. You're supposed to teach FM. You teach half the time maths. What do I do? Tell me, friends. Maths is there everywhere in the life. Correct? So, this, what you know what I'm writing now? Payesh upon number of equity shares divided by, you are, I extra introduce what? Divided by number of equity shares. So in the denominator, I'll also have to do it equity shareholders funds. Let me do one thing. Let me put a different color so you'll understand what is getting introduced over here. Divided by number of equity shares. This also divided by number of equity shares. Okay, it is law. It is something like a scientific research, guys. Right? We are developing something. So behave as smart as scientist. Come on, tell me. The answer in the chat box. That is okay. The numerator will become what, guys? Payesh upon number of equity shares. EPS. Smart, guys. Smart. Smart. EPS upon. Very good. Very good. Equity shareholder fund divided by number of equity shares. There is one formula. Should I tell you the location? Go to the other important ratios. Go to the other important ratios. Now going to that, at least now tell me the name. Book value per share. Smart boys and girls also. Yes. Diva. So it already wrote full EPS upon book value. Smart. So this is what? Book value per share. Correct, friends? So you can see something getting cancelled now. Correct? Agree? Okay. And then book values, market value is known as what? It's market value is known as MPS. MPS is what people really deal with. So what in the next step I do? I say it is EPS minus DPS upon what? MPS. This way also I can calculate growth. Got it, friends? Absolutely sure. Okay, fine. Now I will not bug you anymore. I still have to show you geometric progression. Okay, but then you know what? By showing you geometric progression, we are not going to achieve anything great. We are going to follow this formula only. I told you, satisfaction level. Somewhere it is written, color weight, don't touch. We touch. And guess what? This is correct. So, see, we are not going to have derivation of this into the. We are not going to have derivation of this into the exam. But when you can connect that whatever you learned, okay, in maths is having some usage, satisfaction is also important. So that we will do, definitely will do, but not now, not needed right now. So now, with all these variations, we'll come to the questions based on this. See, people, I have to still cover a lot of things, but we'll first come to questions based on this. I have earlier also told you that we're not going concept, then question, concept, concept, questions. Okay. So, you all guys come to, I hope this is done writing. Nobody's left out, read anything from this. Shall we start with the question? Yes. Up. So now we will come to question number 2. Okay, yes, we are going question wise, concept wise, question wise, concept wise. So come to question number 2. The share of ABC Limited is presently traded at rupees 50. Is presently traded at rupees 50. That's current market price. Now in the terminology, it will become P0. Correct? Now in the formula, it will become P0. Okay. Company, pay attention to the words. Company is expected to pay dividend of 4 per share. Is expected to pay. Means definitely this is D1. It is not a dividend just paid. Expected to pay. So it has to be D1. Everybody okay with this? And with the growth rate expected to be how much? 8%. So guys, this is G, that is 0.01. It plans to raise the fresh equity share capital. Okay. Means now, till now, these conditions all were given over here, never for me existed. They are now planning to raise a fresh equity capital. The merchant banker has suggested that an underpricing of rupee 1 is necessary in pricing the new issue. See guys, what is the current market price? 50 rupees. Merchant banker, you understand, the one who assists you in what? IPO. Okay, is a merchant banker. Hey, look, it is not your bank. A merchant banker is the one who assists you in the IPO process. Okay. So what he is saying, he's like better placed, knowledge wise, information wise. So he's telling you, see, 50 is not a good idea. Keep it 49. Understood? He's saying that you offer the shares at what price to the people. People may perceive 50 as a costly. So people may not buy from you. So what you do underprice it by 1 rupee. Basically, you offer a discount of 1 rupee. besides involving a cost of 50 paise per share on miscellaneous expenses. So guys, what will be the new P0? 50 is what is the price, minus 1 rupee minus 0.5. Understood? Did you understand this, guys? 48.5. Okay. Find out the cost of existing shares as well as new shares, given that dividend rate and growth rate are not expected to change. Means even if you go for new, dividend will be same. D1 would be 4 only, and the growth rate would be G would be 8%. That is 0%. So how many times you have to calculate K? 2 times. One for the existing one, second time for the new one. Hope everybody understood this. So let's do that. So, solution as per question 2. KE for existing shares. So KA is equal to D1 upon P0 plus growth. Let's write the components one by one. These are the existing shares. So what is going to be the D1? D1 is going to be 4 rupees. P0, 50 rupees. What is told in question? The growth is going to be how much percent? 8%. That is 0.08. So how would you write this? D1, that is 4 upon 50 plus 0.08. So 4 upon 50 will be how much? 0.08 only, right now. Plus this 0.08. That is 0.16. That is 16%. Right, friends? Okay. Similarly, we will calculate KE for new shares. We will calculate K for what? New shares. So KE is equal to D1 upon P0 plus G. I think question itself is very clear that D1 is not going to change, G is not going to change. Anyways, we'll mention that D1 is equal to 4 rupees and G is going to be 8%, that is 0.08. So what we expect to change, we expect the P0 to change. 50 minus 1 minus 0.5. Okay, right below. What does this one discount? What does this 0.5? What is said in the question? Miscellaneous expenses. So like flotation cost. Okay. So now get the final answer. D1 4 upon P0 8.5 plus 0.0. 4 divided by 48.5. Whatever answer I am getting, in that I am adding 0.08. And then whatever answer I am getting, that I am finalizing. So I get it 0.16247, so 25. That is 16.25%. Good people, thank you for giving me the same answer. Yes, people. I hope everybody is done with this. So let's come to the next question. Okay. Now we are solving question number 6. I'm first time I'm making you juggle a lot like this, right? Normally we haven't done so, but then this is necessary, guys. Going with the concept, understanding the concept, solving the sums on that. So let's go through question number 6. Okay, let's understand this. A company, guys, pay attention to the words. Huh? Last question, expected to pay the dividend. What is written over here? Has paid. Has paid. So what is this? D0. Remember, you check your book. You have written D1 is equal to D0 plus G. Correct, people? Okay. So company has paid rupee 1 per share. So this is what D0. Face value 10 last year. And it is expected to grow at 10%. So guys, this 10% is our G. That is 0.1. And because of that, D1 would be D0 plus G. Calculate the cost of equity if the market price is how much? 55. These are all small questions. Basically to get you used to this calculation. Okay. So let's solve. Solution to classwork question 6. Solution to classwork question 6. So let's gather the data. No, guys? Let's gather the data. So first we'll write KE is equal to what? D1 upon P0 plus U. Fine. So first we'll write G 10%, 0.01. Then D1 would be D0 plus G. That is, how much is the D0? We said 1 plus 10% of 1. So it will come 1.1. So we now know D, we now know G, we now know D1. And what is P0 given in the question? It has to be given in the question. Market prices 15. Solve it, very simple. So in D1 you will put 1.1, P0 will put 55 plus the expected growth of 1. So 1.1 divided by 55, whatever comes, plus 0.1. So it comes to 0.12, that is 12%. Therefore, KE is 12%. Right, people? G is 0.1. So I have written 0.1. What difference I have written? Oh, 0.0. Sorry. Mistake. 0.1. Yes. 10% is point. Are people? I think error 10% is 10 upon 100 now. 0.1. Okay, fine. Okay. After this, come to come to question number 10. See, why taking question number 10? It's all we are moving around valuation of G, estimation of G, let's say, not valuation, estimation. Okay, what various approaches I gave you. Go through what we have written. Go through what we have written. Have we written that G can also be estimated by the past growth rates and taking an average of that? Correct. See, in the earlier question that you saw, question number 2, question number 6, G was given to you. True, friends? G was what? Given to you. Now what? Now it's going to be like this, that, see, let's read the question. X Limited has shares of rupees 10 each, and the current market price is how much? 24. So yes, we know current market price is what is. Dividend paid by the company in the past 4 years have been 1, 1.1, 1.21, and 1.331. Calculate K. Guys, so that means you are given the trend in the dividend of past few years. So from that trend in the dividend, we can find trend in the growth rate, and that we can apply. Yes, yes, Sumesh, you're right. I know, but I will have to write now. You can do it fast on your calculator, but I'll have to show all the workings. So let's come to question number 10. Solution to question 10. Okay, so let's gather all the data that is given in the question. What we are told, P0 is very clear. P0 is how much? 24. Okay, so let's do one thing. Trend in dividend of how many years? 1, 2, 3, 1, 2, 3, 4. Trend in dividend of last 4 years. Now let's do trend in dividend of last how many years? 4 years. Okay. So I would say year 1, 2, 3, 4. Dividend. Year 1 the dividend is 1, then 1.1, then 1.21, then 1.331. Okay. Then what we will find? Percentage change. How is it calculated? That is change upon the original into 100, right? So when you have to calculate change, obviously change can't come in the first year. When after first year, when the second year will come, then only the change can come. So how much will be the change? 1.1 is a new minus 1 original upon the original, that is 1 into 100. You get 10%. Okay, again you can write out from second year to third year. So 1.21 minus 1.1 upon 1.1 original into 100. Again you calculate 10%. Hello guys, is it coming at 10% every year? Enough? Okay, good. So 1.331 minus 1.21 upon 1.21 into 100. Again 10%. So what we can say? Thus, from the trend, it can be seen that there is a constant growth of 10%. Correct? Therefore, what we will say? Therefore, we will say G is equal to 10%, that is 0.1. Now, if G is obtained, then we can obtain D1 also. Guys, this is the dividend of last 4 years. So, we will need the expected dividend. So, what is the last dividend that you have? 1.331 plus 10%. 1.331 plus 10% gave me 1.4641. Now I think we are set. We have been having all the values. G we have, B1 we have, and P0 we have already written at the top. 24. Right, friends? Let me calculate. Therefore, KE is equal to D1 upon P0 plus G. 1.4641 upon 24 plus 1.464 divided by 24. Some big answer came plus 0.1. So I got it 0.16 1610 and then 4. Now can I round it off? No. So that means 0.1610, that is 16.1%. Then after 1 there is a 0. So even if you write 16.1, that is also fine. 16.10 doesn't make any difference. Array whomsoever is asking me. Sir, can't we take 1 as the original dividend in all the years? How we calculate percentage change, guys? Difference between the last year and this year, right? Huh? So one more zero is there in between. Okay, fine. Thank you, sir. I know. This page over. Page over, sir. Break time, sir. Okay, fine, guys. Hello? Good on my people. Hello, everyone. Uh, 5 minutes break, then resume back. Out. Yes, people, let's join back. Good morning once again. So last we solved question number 10. Okay. Let's go ahead with question number 11. Let's go ahead with question number 11. Okay. See what is told. The details of dividend paid by X Limited on existing equity shares of rupees 10 each for the past year as follows. So your 1, 2, 3, 4, 5, and the dividend per share is given to you. Guys, you can make out now. It's for calculating the trend in the change in dividend. Okay. Just that in the last question it was same every year. So you could easily just copy that number. Here it's going to be different. I'm telling you upfront, those who have started solving, right? So I'm just telling you that here it is different. So what will happen? Whatever values you get now, take the average of that as an expected growth rate in future. Okay. So you should not face any sort of disappointment. While calculating, you should not make any mistake. That's it. And I'm reading. So current market price is 40. What we call this, guys? We call this P0. The company is planning to issue new shares of rupees 10, which is the flotation cost of 5. Guys, listen. Existing shares. Hello, 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 hello. 1, 2, 3. Hello, 1, 2, 3. Existing shares have a market price of 40. Fine. But if new shares are issued, then there will be a flotation cost of 5. So this 40 rupees P0 we have marked now. That ahead of that you write existing shares, right? So this P0 is for existing shares, and then P0 would be 45 minus 5 for new shares. Okay. Calculate K for both. Calculate K of what existing share and that of new shares. Okay, fine, we can do that. So let's start with the solution. Let's come to solution to last question. Guys, I suppose first we'll have to find trend in dividend. Correct? Now, without doing that, we cannot proceed further. Okay, fine. So we have now data of how many years? 5 years. Year 1, 2, 3, 4, 5. I purposely leave a line in between so that it doesn't become clumsy when we are writing. Okay, remember that. It's a small thing but matters. Dividend per share is 1, 1.06, 1.1025, 1.16, 1.23. Okay. So as usual, we'll find percentage change in dividend. This obviously first year we don't calculate that. So here it will come 1.06 minus 1 upon 1 into 100. I think it's very clear, 6%. Okay. 1.1025 minus 1.06 upon 1.06. 1.1025 minus 1.06 divided by 1.06. We should say 4.01%, 4 digits. I'm sorry, 2 digits, 4.01. Then 1.16 minus, yes, I noted your reply. Thank you, Roshan. 1.1025 divided by 1.1025, 1.16 minus 1.1025 divided by 1.025%. 5.215, right now, guys? So shall we say 5.22%? Yes. And then the last one, 1.23 minus 1.16 divided by 1.16. 1.23 minus 1.16, whatever came, divided by 1.16%. 6.034. So 6.03. Yes, correct. Yes, Roshan, 6.03. Now, what do you see, guys? Like the last question, is there any standard trend? No. What do you do? Take an average. It's an expected growth in future, no? So let's take an average. Oh, so measure is done. Good. Since growth rates are different, therefore, let's take average. Therefore, growth is equal to 6 plus 4.01 plus 5.22 is 6.03. So 4 values, no? Divided by 4. 6 plus 4.01 plus 5.22 plus 6.03 divided by 4 is 5.315. So let's take it 5.32%. So we have got a growth now. Guys, we normally need it like this. No? So what you do, you say 5.32 divided by 100. So it comes to, without any confusion, 0.0532. Right now we need to add it like that also sometimes at the end. So now let's make it a, okay. See, first of all, we will write D1. Therefore, D1, what was the last dividend? 1.23, correct? 1.23 plus growth, na? That is how much? 5.32%. So 1.23 plus 5.32%. 1.295. So let's make it 1.30. So people, excuse me, this D1 calculation is clear to everyone. Whatever is the last dividend, 1.23, in that we added the growth rate. So it came to 1.295. So fine enough, 1.30. So now we calculate we say KE for existing shares. We are doing two calculations, no? KE for new and KE for existing. So KE would be D1 upon P0 plus G. D1 will write 1.3 P0, what is the existing price given in the question? 40 rupees, correct? Plus growth 0.0532. So 0.3 divided by 40, whatever comes plus 0.0532, it came to 0.0857, right? That is 8.57%. Let's do A for new shares. What is going to be the only change? Let's write KE is equal to D1 upon P0 plus G. I think P0 will have to show again. Originally it is 40, but minus 5. What is that? 5 rupees. Flotation cost. So this is going to be 35. I think the rest of the numbers will remain same. So 1.3 upon 35 plus 0.0532. 1.3 divided by 35. Whatever comes plus 0.0532. 0.0903. Correct? So 0.09034. So 03. That is 9.03%. Now people tell me, are you able to reach to your managed, confirm? Okay, fine. Let's go ahead with the next question, guys. It's okay if you don't change Someshwar. There won't be much difference. Don't worry. Let's go to the next question. We will go to question number 12. Yeah, that's what the company plans to do. The new shares, Sahil, what is written in the question, the new shares are expected to have some flotation cost. Means what? Some cost of issue. So whenever the company will issue the new shares, it is expected that they will be issued at what price? 35. Okay. Fine. Let's go to question number 12. Yep. Equity. Hello, people. Are you getting strained that, sir, how many questions we are solving in a day? See, it's like we talk about two questions of 20 marks, right? Or we talk about 20 questions of 2 marks. You understand how I'm going? I'm not taking any bigger sum. I'm making you ready in the installments. Calculate this, calculate K, calculate KD. Do everything in small chunks. Then once you are set, then we will do one big question. Okay, so purposely I'm doing it like this. Okay, just KD, just KP, just KE. Right? Now so we are going to do just G. Let's see question number 12. See question number 12. G calculated. Okay. Let's read. Equity shareholder funds is how much? 1 lakh. Congratulations. Returns on equity is 20%. Dividend payout is 40%. Calculate growth rate. Assume ROE and payout remain same. Ignore DDT. Guys, I suggest you to cancel this now. There is no DDT. DDT is gone. So what guys, you understand the theory part I've told you, know. I've told you how this way also you can calculate G, right? So I'm showing you all possible variations. Okay, first before you get into big questions, showing you all possible small verifications. So let's go to solution to classwork question 12. Okay, what is given in the question? Returns on equity is given in the question. Yes. Returns on equity is how much percent? 20%. That is 0.2. Then, guys, you are given with dividend payout ratio. How much percent? 40%. Then we all know dividend payout is 40%, means retention is 60%. Yes. Good people. Good. Therefore, retention is 60%. So we have a very simple formula. G is equal to what? V into R. V stands for retention. R stands for ROE. Okay. So retention you put 0.6. Okay. And ROA you will put 0.2. 0.12. That is 12%. Easy. I'm sure you all have got this. No big deal, sir. Very easy, sir. I told you, huh? I don't at all teach difficult things. I can't teach difficult things. It's only simple things. Difficult I can't teach. Then, guys, let's go to the next question. Question number 13. This can come in the exam. You have any issues if it comes in the exam for 2 marks? No, it's too easy. I want something challenging in my life. We should be happy if something like this comes. In fact, every day, night while sleeping, we should pray to God and please give this kind of questions only in the exam. So you guys try to understand my setup, that I'm trying my best to put the things in such a way that whatever theory part you've written, everything is getting covered in the questions one by one. Okay, so not like you see the theory and then you're searching for the questions based on it. No, not like that. Fine, we'll come to this question. Question number 30. Fincon Limited is planning an equity issue at the current year. It has expected EPS of 25. Guys, EPS, and proposes to pay 15 rupees dividend. So we can say DES or D1 as 15. P ratio is 8. PB, price earning ratio. Hello people, okay, na? In some other topic they ask ratios. Even if you're not okay, you have to do with it. Right? So P will help us to calculate what? Come on, tell me. MPS, correct now? MPS. Now you remember one more way of estimating growth. I'll show you what we wrote. You can see in your notebook while I'll show you over here. See, when we talked about this various ways, you realize that we are doing one by one. We have done a questions based on this average of the past years. Then we done a question based on this just now. right? And now we are going for a question based on this idea. APS minus DPS upon MPS. Are people, you understand things are not happening arbitrarily, they are well planned step by step. Okay. So let's go to that. However, to first read the question, and let's complete the reading first. The app also says enough, you got a lot. Okay, P ratio is given a P8. So it will help us to calculate what? MPS. Guys, you remember how to calculate MPS? MPS would be EPS into P, na? When did we do this? Have we done this before? MPS is equal to EPS into P. Or just in capital structure. Select the plan with highest EPS. Then they tell you that P ratio is 20, 17, 16. Then you multiply by that and obtain MPS. Remember? Okay, fine. It wants to offer the issue at market price. The flotation cost is expected to be what? 10% of the issue price. So what you are required to find out, determine the required rate of return for equity, that is A, before issue and after the issue. So to do this calculation how many times? 2 times. To do this calculation 2 times. Fine. People have reached the answer before I could think of writing. Only thing is there are slight variation in the answer, so I think it is better that I solve it. Yes, obviously. Okay, we are solving. We are solving, guys. If you are taking efforts to solve, that is really good. You can cross check over here. You appreciate your efforts always. Question number 3. Solution. Solution 2. Last one, question 13. So let's first gather the data now. APS 25. DPS unexpected. So D1 only 15. PE 8. Okay. So what we'll say KE first we'll do for existing shares. Okay, we'll do KE for what? KE for existing shares. Therefore, KE is equal to d1 upon p0 plus g. See guys, but you can easily fill up is only d1. Rest of the things you have to work out a little only, huh? Not too much. See, first of all, you should know that now we can get growth as what? EPS minus DPS upon MPS. So EPS, DPS is there, MPS is not there, and for that you use P. Right? P is 8. So what are we going to say? MPS upon EPS is 8. Substitute. EPS is 25, so MPS is going to be 25 into 8, that is 200. So G is equal to 25 minus 15 upon 200. 25 minus 15 is 10, 10 minus upon 200 is 5%, so 0.05. Okay, guys, listen to me carefully. This is an expected dividend only. Already D1 is given, so don't add further G to this. Upon P0 how much? 200 plus a growth of how much? 0.05. So 15 by 200 will be how much? 7.5. So 0.075 plus 0.0 0.125, that is 12.5%. Hello people, hope you have got this. This is our K for what? Existing shares. Now let's go for KE for new shares. First of all, understand MPS new. What is written in the question? See, we got it 200, but what is written in the question? So it's going to have 10% flotation. Correct, people? I hope everybody has understood this. So we will estimate this as on how much? 180. And if the MPS changes, definitely the estimates of growth will also change. So it is EPS minus TPS upon MPS. EPS DPS remains same. Agreed. 25 minus 50. The MPS will change to 180. So 25 minus 15, whatever divided by 180 is 0.055555. 0.0556. Fine, now we just have to take 0.0556 now. Okay, so let's do K for new share. Okay, formula remains same. K is what? D1 upon D0 plus G. D1 would be same, 15. Yeah, but P0 will change now. Will become 180 plus 0.0556 divided by 180 plus 0.0556. So we get 0.1389. That is 13.89%. 13.89. Please round up to 2 digits, guys. Okay, so now if we will go to the next question regarding a concept. Cost of retained earnings. Guys, I'm going to give you one more work. Okay, go through, means once you are done with the class, okay, go through your notebook. Wherever you find a concept, put a box and write concept. Or first write concept, then put a box. But write. Huh. Because see, that is necessary, friend. Please understand. Otherwise, the benefit will should not turn into disadvantage. Right now, you have understood what we have done meticulously. Concept, concept, concept. Question, question, question. That benefit should not vanish away, should not disappear. So later on, you do that. A concept, box, box, concept, whatever you are okay. Shall we write the formula for this? Are we ready, guys? Shall we write the formula? Yeah. Okay. Write the formula. KR is equal to K. Done. What else do you expect? What is retained earnings? The accumulated reserves. See, I'll explain you with the logic. Why KR is equal to K. KR means it's retained earnings. Okay. Whom it belongs to. Don't say company. Equity shareholder. Reserves belongs to whom? Equity shareholder. Okay, fine. So equity shareholders are like daydreaming. I would invest like this. I would invest like that. I'll get this much return. I'll get that much return. Thousands way of investing. So be a successful investor. They start reading the book. And then in one line company tells them, you read the book to become how to become successful investor. But ultimately the money is with whom? Money is with company. And who takes investment decision? The company only. Are you getting me, guys? I understand. Money belongs to equity shareholders. Correct. Money belongs to equity shareholders. True that. But are investing decisions individually taken by equity shareholders? No. It's in the possession of whom? The reserves are in possession of whom? Company only. Company only takes the decision. So company tells you, like, hey, equity. See, I am giving you KE on your shares. So I'll give you the same rate, KE on your retained earnings. That's so simple. Okay. So let's write this. YKR, YKR is equal to K. Retained earnings belong to equity shareholders. Obviously, retained earnings belong to whom? Equity shareholders. But they are in possession of company. Therefore, decisions of investing, retained earnings, decisions of investing, retained earnings are taken by company. Therefore, management gives KR just equal to what? A. Simple. Yes, people, are you done? Okay. Now, see one common understanding. Till now, what we did, individual A. Let's start from KD, KD, KP, A, individual. But what do you think? Company generally issues the capital as a mix of everything, right? So then we have to learn to calculate the overall cost of capital also. Okay, that is what is known as WACC. Means before I take any next sum. Now we are going for a full-fledged sum. Huh? You have done everything in parts. Now you'll understand what I've been talking. You have done everything in parts. KD separate, KP separate, KE separate. But understand, the company never issued only one source of capital. Company issues what? Various sources of capital. Right? Everybody agrees on this. Huh? Okay. So what we are going to do now, before we go for the next question, we will understand how to calculate weighted average cost of capital. So before we step into the next question, weighted average cost of capital. Known as WACC, overall cost of capital, and KO, management uses various sources of capital to raise the capital required. Therefore, it calculates WACC. So, guys, am I going to teach you any more method or formula? No, WACC, weighted average cost, which is like considering everything, all sources of capital that you might have used while raising the money. So, how it would appear? Simple, like any weighted average we do. We'll write the source, we'll write its cost, we'll write the amount of the particular capital. Multiply this, okay, and then we'll get what? Product. The amount of every capital source that we use will become the weight. So, examples: equity, cost K, amount, product. Then preference, cost KP, amount, multiply, give the product. Then debt, cost KD, multiply by the amount, with the product. Reserves and surplus, KR, multiply product. And we know KR is same as what? K. Done? What we will do next? Take the total of this. Take the total of this. Therefore, WACC, total product upon total mix. Understood? Good. Fine. We are still to write few things about it. Guys, now we are talking about applying some weights over here. Okay, we're talking about applying some weights over here. Just to tell you, you might find at some places that whatever amount we are writing now, they are not directly taken as weight. First, they are converted into percentages and then that is taken as a weight. Like suppose the amounts are 1 lakh, 2 lakh, 3 lakh, or say let's take up some easy figure, 5 lakh, 5 lakh, 10 lakh. What we are going to do? Take 5 lakh, 5 lakh, 10 lakh. But we have to do it on calcium only, na? What is the weight? What is the percentage of 5 lakh, 5 lakh, 10 lakh? 25, 25, 50. So somewhere you will find people doing 25, 25, 50. I think that adds to our work. As long as the numbers are easy, we can do oral. If numbers are complicated, 16 lakh 26,280 in equity, 3 lakh 32,482.5 in preference. Then converting them into percentage is a big idea. What we have to do, we have to just type the number over here. Correct. In spare time, what you do, you try that. You take the direct amounts and solve and get the answer. You convert those amounts into percentage and get the answer. Answer is to come same rate. Okay. So just telling you, briefing. Anyways, first, let's continue writing below this. Types of weights taken a certain K. First one, book value. What is the first one that we are writing? Book value weights. Nothing will be accurate, right? I'm not teaching accounts by any chance. What are these? Estimations for the future. And that's why we have different option. Okay. See, when accounts professor teaches you to prepare balance sheet, does it teach you either take these values or take that values? You take either of the values and then your balance sheet won't tell you. So it's not like calculation. So more so like what? Estimation in the future. Book values, right? Balance sheet values of each source. Balance sheet value of each source of capital is considered. Okay, means you will when I'm writing these amounts, no, I'm talking about writing these amounts. Book value X means what? Open your balance sheet, copy the amounts from there to here. Balance sheet equity value, balance sheet preference value, balance sheet debt value, balance sheet reserve value. Copy, right? Book value X, right? Number two, market value weights. What will write? Market value of each source of capital is considered. Market value of what? Each source of capital is considered. Now, some important point related to this. Between market value and book value, comma, preference is always given to what? Market. Yes, market. Preference is always given to what? Market value. Since what? Since investors invest at which value? Market value. One more important point. While calculating KO at market value, ignore reserves. Read it carefully. While calculating KO at what? Market value, ignore reserve. They are assumed to be included in market value of equity. You understand what we write? We are going by market value rates. We take market value of equity. Guys, why the market value of equity is different than the book value? Because it considers the market value considers the impact of reserves also. See, when I told you that okay, book value of the or the face value of the share of MRF is 10 rupees. I don't get it for 10 rupees in the market. How much I have to spare? I have to spare around 78,000 rupees. Why people are ready to pay so high market value? You remember we had done some calculations. Book value per share is around 30,000 rupees. Means that means 29,990 is what is the valuation of reserves. So correct, 10 rupees is the face value. Book value is 30,000 rupees. So extra 29,990 rupees is what? That extra 20,990 rupees is all about the reserves. So in the market, people are ready to buy the share at what? At 78,000. What does that mean? So people are considering the valuation of reserves also. They know okay, the company is having so high reserves, so they are ready to pay so much. Getting me? Okay. So if you are going for market value, keyword market value, then please do not consider reserves separately. What is understood that reserves are a part of what market value of equity. If you all understand, so you can give me some confirmation, guys. Okay. You. Okay. One last wait. Third one. Marginal value weights. Okay. You understand, guys? Marginal word means what? Additional. Hello. Marginal utility you learned. No. What is that? Additional utility. Right? Okay. Fine. So right over here. Whenever we have to calculate WACC for any specific or additional project, marginal value weights are considered. In this case, only the proportion of additional funds is considered. Only the proportion of what? Additional funds is considered for calculating WACC. People, are you done writing? Done, huh? Okay. 15 minutes are there. Fine, we'll go to the question. Sir never says like this. 15 minutes are there. I'll leave you a little early. Okay, let's. I understand your concern. You always have a next lecture, sir. Get lecture. We will get time to eat food, sir, etc. etc. But I generally don't delay. No, I give you on time. Sir, this question is so big, sir. We read only, sir. Ah, yeah. See, the theory requirement will come now. I want this screenshot. I want that screenshot. This is how people will manipulate and will make sure that below question number 13. Then what was that I was showing on the screen for such a long time? Okay, you want me to go a little like this? This is first you take this one. This is this page you all take. Those who want. So we know how to do time this. I can ignore also. People say I want this theory, I want that theory. What do I do? Tell me. Successfully will not allow me to start the question. Huh? That's the plan, nothing else. Now see, now people are writing like question 3. So keep hopping. That's it. You sir, you hop sir from here to there. That's it. Okay. What's so great about question number 3? Question number 3. Enjoy your day then, Sania. Done. Requirements done. I understand. That's a now that it is not possible on this, sir. Very less time left. Very true. But at least I can brief you. Okay. See now, a full-fledged question be like this, right? So listen to me. Listen to me. This. Because what you have done, there were questions in small parts, chunks. Okay. Now see, this is a full-fledged question. Okay. What do you see over here? That the balance sheet gives you ordinary shares. It also gives you share premium. It also gives you retained profit. So basically, these two are your reserves and surplus. What is this? This is reserves and surplus. Then you're also given preference shares. You're also given perpetual debt. See, people still they are making perpetual. No redemption. all the data as well. See, ordinary shares are currently priced at 39. So what is this, guys? This is P0. Okay. And rupees 25 preference shares are priced at 80. When I say rupees 25 preference shares, then this rupees 25 is a face value. This rupees 25 is what? It's a face value. Achha. They are priced at 18 come dividend. Guys, you understand come dividend, X dividend? Hello? Come dividend means what, Ray? Including dividend. So you should always remember one thing. X dividend means what? Excluding dividend. So one you understand, the second you understand. X dividend is excluding dividend. X, remember like that X is a shortcut. X dividend. So what is the full form? Excluding dividend. Some students always have to do toss. Come means what? X means what? They do toss every time. Sir, confused. So do toss. So better remember like this. X means excluding. So the other one you don't remember. That automatically comes. Yeah. So this is including dividend. Debentures are selling at 110% of the X interest price. And tax paid is 40%. D Limited's cost of equity has been estimated at how much percent? 90%. Now see what they're asking to calculate. They're asking to calculate the weighted average cost of capital based on which value? Market value. Guys, go through the notes. Go through the notes. Weights, right? What are the possible weights? They can be book value weight and market value weight. Question is very clear. Calculate on which value weights? Market value weights. Right? And then when you do market value weights, remember that KO, overall cost of capital. Munni, I wrote it over here. Who's asking me what is KO? Co. People are half sleeping. No, sir, not at all. We are full sleeping, sir. Don't worry. Back to question. You're just ensuring that this fellow by any means should not say, okay, let's complete it out. The timer is going on, sir. 7 minutes. Sir. Not good to start, sir. People are saying their eyes only are not opening. You know when they will open? 2nd November 21. Okay. When I say class is over, correct. Fine, friends. Yes, I genuinely don't mean to start with this some right now. To take some time. I don't want you to rush through the process, but I just. Also, it can open at 7:30 as there is a match today, CSK. Great. Thank you for the valuable input, Hariharan. See, now people come to life. When I say that, okay, I'm not going to solve this question now. People suddenly come to the life. Yeah. Thank you so much. Thank you. So nice of you. Anyways, we are not continuing right now. Done for the day because genuinely we will not be able to solve and we have to rush through the things. Let's not do that. Okay. Happiness, all the time. Good. Okay, people. See you in the next class. I think not immediately. The next class is on Sunday, 2nd May, right? As per our timetable, right? So till that time, what to do? Tear each one page. Okay. Cost of equity, cost of preference, KO. Don't Just close your book and forget. No problem, sir. We'll keep the book open and still forget. Revise in the next 2 days. Don't come blank. Okay. Fine. So, what do you want to ask, Shweta? If you could put it small out, you put it in the chat box. My God. So many people have so many doubts. Sir, I have one doubt in receivable management. Calculation of sales can be done on sales when variable cost is there. I think we have this discussion done number of times. All three options are okay. Whichever you love. You have affinity for sales, do it. You have affinity for variable cost, you do it. Whomsoever fee attracts you, write a note. In India, what to do? By giving note, the things are solved. Means in the exam, I'm saying write a note. Then there is no problem. Whatever you have done, you write. You support it by note. Okay. Did I tell you that keep pink color notes in the answer sheet? No, I told you to write. I told you to write. Okay, write a note. Zero worries. You can follow anything. Sir, if company issues new shares other than first time, they will issue it nominal value or market price. What is your opinion, guys? Market price. Come on. Huh? You think that companies like Infosys, companies like Reliance, selling at 3,000, 2,000, and they'll give you for 10 rupees? So why is redeemable preferences and debt is divided by average and not just by net proceeds? Opening value, closing value. There is a difference. So we consider average value. Sir, show ratios at glance in Zoom mode. Okay, fine. Let me complete a reading. Want to talk? No, I don't want to talk. Wait. Sir, but in test they have marked as wrong. So now that you complain to your branch head, okay? Any approach is okay. Any approach is okay. Sir, in question 10, while calculating D1, we add 1.331. No, we whatever is the last dividend in that we add growth. Whatever is the last dividend in that we add growth. Right? D1 is always D0 plus growth. You know, if you have got something as wrong, please inform your branch heads. But if you ask me as your professor, I will tell you alternate values are approved by ICAI. ICAI says the same thing. ICAI also understand. You become chartered accountants. What will you do? Right? So take note, give note. Means take note from me and give in the exam. That's it. Okay. So come on, we are done. All that is fine. Rounding off you do here and there. That is fine. 1 point here and there is okay. Now who else is left? Someshwar, what's Ashweta? Someshwar, what do you want? You want to ratio that glance? Okay, take a glance. You want me to put like this? Half half? Munna talk re. Full. I'll turn it like this. See. No clarity while printing. That's what I'm saying. So that's what I'm saying. That what I will do, I'll convert it into landscape mode. Arr, arr, arr. say it's not going. I have unpinned the command bar. Ah, yeah, bye. If you're done, you can leave. You're done. Arey, I zoomed and it will go out of screen, na. Someshwar, you don't understand or what? You'll come at my home or what to get into the other side of the screen, right? If I zoom now, what will happen? This goes out of your screen. How you take? That's what I was telling you. I'll show you two parts. Someshwar not understanding. Hey, Someshwar. Someshwar. Ah, now do one thing. I'm telling you, do. Hmm. First, take only this much photo. This should be visible, Someshwar. Right? That's what I've been telling through you. You're telling me zoom, zoom. But if I zoom, then it will go out of my screen. Then what is the point? Your problem with Lenovo also. What? Fine, happy. Now I will show the other issues also. Now see, it will be able to take it comfortably. Then, then what is required? Shalini is there in the meeting. Theory for people approaches for both.
Sir, in capital structure, the answer given in homework side is wrong, sir.
You correct it.
Okay, sir.
You solve correct, na?
Okay, sir.
Shalini is there. She is asking for some screenshot. Now you keep quiet. I will listen to you a lot. Sir, can you show theory part before approaches for estimation of K? Okay. Theory part before approaches for estimation of K. It's over here. Shalini, I think you wanted this. Shalini is there in the meeting or not? Done now? Okay, fine, sure. So, chalo, let's stop for the day, guys. See you in the next class and revise. Bye, 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 bye. Chalo, bye, bye, Sumeshwar. Bye, Uya, bye, bye, Shalini, bye, Sriram. Chalo, good, take your break. Now we have a next lecture, night 10 o'clock. Oh, so you have all the time in the world. Okay, okay. Enjoy your day. Huh? I have a lecture. Bye.